Time now for a deluxe three-stock lunch. We'll get the stories on three stocks making headlines today, then get the trade on each one. Today, we're joined by David Traynor. He's the CEO of New Constructs. First up, David, is Alphabet. Closing arguments today in the Department of Justice's case to break up Google's so-called monopoly on search. Eamon Javers has a little bit on that story for us. Hi, Eamon.
Hey there, Tyler. Well, closing arguments have closed here in the Eastern District of Virginia in Alexandria, Virginia. Take a look at the Google lawyers leaving the courthouse just a short time ago. They were pretty confident as they came out of the courtroom today. You see some smiles all around there. Google lawyers dismissing the DOJ's case, saying in a conference call with reporters afterward that it was just a lot of rhetoric from the Department of Justice today. Here's a couple of the points that I want to flag for you that each side made. On the Department of Justice side, in their closing arguments, they said that all but one of Google's live witnesses are paid by Google. And they said that the witnesses they've called, obviously not on the Google payroll. They said that the last look provision inside these auctions, in which Google gets to look at the price and decide if it wants to bid at the very end, gives Google an unfair informational advantage. And they said that the court should draw a negative inference from Google's destruction of internal communications, you know, those 24-hour expiring chats and shifting a lot of the conversation in that direction. They said that's an indication that there might be more negative information out there that we can't put our hands on. As for Google's closing arguments, they said, look, prices are falling in this market, quality is going up, publishers are making more money, so what's the problem here? They said the rest of the industry is growing faster than Google, that its share is going up, but not as fast as the size of the industry is going up. And then they went back to history, both sides sort of debating this point a little bit, looking at the big antitrust cases of the past, going back to Standard Oil at the beginning of the 20th century, AT&T and Microsoft, arguing that those guys had historically had much higher market shares before they were broken up by the government, saying if you want to compare us to them, this case doesn't meet that standard. So a fascinating set of arguments here today, guys. They expect that the judge will make a decision by the end of the year here. Back over to you.
Very interesting. Eamon Javers, thank you very much. David, let's get a quick trade. Buy, sell, or hold?
We're a hold on Google. We think this is not the end of sort of the regulatory warfare. It feels like forever now that the regulators have been out after Google. Don't get me wrong, it's one of the best businesses of all time. Super high return on capital. It's at 46% now. And we know Google's been a great innovator. But the valuation here doesn't really leave much upside left. And so we think, given the regulatory overhang, it's better for folks to stay on the sidelines with Google.
All right, fine. Let's move to Target then, with Oppenheimer naming the stock a top pick, arguing it's too attractive to ignore at current levels. Remember, the shares cratered last week after its biggest earnings miss in 2 years. Courtney Reagan is here with the rundown. Courtney?
Hi, Kelly. So after a long winning streak during the pandemic, Target began to put up some inconsistent results quarter after quarter. Several quarters, including this most recently reported one, from a series of its own missteps, and not really a reflection of the broader consumer. So the retailers had trouble matching inventory with demand in some cases, ordering too much of the wrong stuff post-pandemic and then having to slash prices to move it, to then making a series of costly moves this past quarter in order to bring merchandise in early or in different ways than originally planned to circumnavigate what ended up to be a short-lived port strike, but it cost them. Plus, shoppers have been more discerning after pandemic buying when buying more discretionary items, which is where Target's core categories really lie. But Oppenheimer's Rupesh Parikh is betting on its ability to turn it around. He's adding Target back to the top pick list, and Parikh thinks the worst is behind Target, that the stock has it all priced in, all that negative plus some, in fact. He likes what he sees in the stores for holiday, and he thinks the retailer can hit its guidance. He believes in management's ability to get back to sales growth. I don't know if David agrees.
David Traynor, your bat. What do you think? Thank you, Court.
I do agree. And one of the things we like most about Target is that the executive compensation is aligned with return on invested capital. It's always a really good thing when we see executives making sure that they only get paid when shareholders are getting paid. That's way better than what we see for adjusted EBITDA and all these other executive performance metrics that are much worse. So I'm very much in agreement with Rupesh. I think the stock looks really cheap here. They've got great intelligent merchandising. They've been very dynamic. I think Target's got a lot of upside left.
All right, let's get a thought from you, Ken.
I agree that it's very important to align executive compensation with shareholders, but I will channel what Carl Icahn says on that topic, in that if the Yankees hired me tomorrow and paid me $1 salary and $1 million for each home run I hit, I still wouldn't hit any home runs because I can't hit major league pitching, meaning executive competence is more important to focus on than executive compensation.
All righty. Final name is EQT. Morgan Stanley hiking its price target, citing bullishness for nat gas prices. Pippa Stevens has the story here. Hi, Pippa.
Hey, Tyler. Well, EQT is one of the few bright spots in the energy sector today, with Morgan Stanley also saying they expect the gas driller to reduce net debt from $13.7 billion today to $7.2 billion by the end of next year, meaning the company could resume buybacks in 2025. Now, EQT has also fully reversed prior gas curtailments and today announced a $3.5 billion midstream joint venture with Blackstone that will see the alternative asset manager take minority stakes in some of EQT's pipelines. But the biggest driver of the stock today is perhaps the jump in nat gas, which is on pace for its highest settle in more than a year on forecasts for colder temperatures, as well as a record amount of gas flow to LNG facilities. Bank of America is saying today that winter is now the key price driver for nat gas, and that despite price weakness, demand is at an all-time high, and reduced production should support prices into next year. Tyler?
Yeah, thank you, Pippa. You cannot postpone winter, David. What do you think here?
Nat gas. We're bullish on a lot of energy stocks, but not EQT. They've destroyed a lot of capital here in the last few years, just been really aggressive with acquisitions, paying top prices. So free cash flow has really suffered. That said, we're more hold than we are sell because, look, if they can put this sort of fully vertically integrated natural gas production into place, that could be a good thing. So being bullish on the energy sector, we can't say they're not going to do it, but we wouldn't be aggressive about buying the stock here because we think it's plenty expensive. And management, to the prior point, management has not shown great capital allocation success up to this point. So even if they were paid on ROIC, I don't know if it'd be a good thing.
David, thank you so much for your perspectives today. David Traynor, we appreciate it.
Thank you.